First up, the deteriorating condition of the South African consumer has become apparent in recent months, and this is reflected in the share prices of consumer-oriented businesses like retailers and banks. The key in investing is, of course, to decipher whether the values of companies as offered by Mr. Market accurately reflect the conditions and prospects of the underlying business. As one of the country's most successful investment firms, Mike Suku from Ford Asset Management joins us to weigh in on the subject. So the current consumer environment, let's start right there. Are you concerned with the recent news flow and the resulting impact it has had on some of those consumer-facing stocks? And of course, here I'll mention something like Able, which has bounced since the PIC took a 15% stake, but is obviously still in relative trouble from a share price perspective.
Thanks, Warren. Thanks, Warren, for having me. Obviously, it is quite important, and it is a sector that we've identified, and we identified it a few years ago, as we've mentioned before, as the one area in South Africa where we thought investors would do well by investing in those stocks. And it's generally because the governments have given above inflation increases, and 16 million people get social grants. So we've identified that area for a long time now, and we've done really well out of that area. In the last quarter of last year, we lightened. The PEs got a little bit high. They got up to 25, so we lightened. As I said, we never sell everything. We take a long-term view. We still like those businesses. We still like the Mr. Prices, the Fashinis, the Truworths. We think they're good long-term businesses to have. Now they're getting back to a level where we could be looking at them again, looking at interested. I see Truworths today has come off again, and you've got Truworths now not on a 25 PE anymore, but on a 14 PE. And they're on a 5% dividend yield and a 5.5% dividend yield.
This is a buying opportunity, in other words.
Yes, so we would think you've had this pullback now, the consumer is still going to be okay. You could even see that from the latest GDP numbers that came out. Even though they were disappointing, the one area that stood up reasonably okay was the consumer. So, and again, we're going to go ahead with wage negotiations now again. They're going to be 8 or 9%, and inflation's at 6%. So even though inflation is ticking up and the consumer is under a bit of pressure, we're still comfortable that this is still a good area to be in. Yes.
Mike, we've got this, what comes to mind is Malcolm Gladwell's book, The Tipping Point, because we've had a great run with the consumer. I think if you'd purchased some of these retailers back in 2003-04, like I'm sure you did, you've got multiple returns on your investment. But at some point there might be a tipping point where the consumer becomes too indebted. Is that, first of all, is that easy to gauge from your side? And it doesn't sound like a concern, but if it is, especially on the debt side, banks like Capitec and Able would obviously be avoided. If you don't believe that, inversely, I'd imagine you'll be buying Able at these levels.
See, I think this is a long-term thing, and I think we've seen this before, where the consumers come under pressure, the banks stop lending because they're worried about the debt levels of the consumer. A year down the line, the consumer's paid off some debt, he's in a better position again, and the banks start lending again. So we think this cycle plays out many, many times, over 30 or 40 years. So banks are withholding that. Interesting article in the Sunday papers this weekend by Rian Stassen, the CEO of Capitec, saying that a lot of that lending has actually gone into the middle income range now. So whereas before you would think that lending was more on the bottom end, it's moved up, and they're aware of it, and that's why they've pulled back the lending, but they don't think it's going to impair that book.
Mike, let's drill down a little into the Ford Balanced Fund and look at your equity exposure, JSE equity exposure, which is some 42.8%. So when I look at your allocations, BHP Billiton is your biggest play, followed very closely by Aspen. Talk to me about BHP Billiton, and then obviously the defensive nature that you're seeing from Aspen, and the fact that that stock is consumer related.
Yes. Bronwyn, we still commodity bulls, we China bulls, so if that is your scenario, we do think that this economy is healing globally. We think America is starting to definitely show signs. You can see by that property prices are up 11% year on year. So things are picking up there. China, we're still very comfortable that we're going to have growth between 7 and 7.5% over the next 5 years in China. And Europe, we actually think we might start seeing some green shoots towards the end of this year in Europe. And so
Is that not a relatively optimistic view? And I've had this discussion with Paul Theron recently where he threw around the green shoots and I said, are you sure they aren't already wilted and that they're not going to get off the ground?
You know, I read The Economist last week and it was amazing. Even in countries like Germany, they're expecting 17 million tourists over the summer period. They've laid off 300,000 government workers up till date. So in these countries, there is reform trying to take place, and we do see there is succeeding. So all that needs to happen is that America does start picking up, their economy picks up, and suddenly Europe have got a place where they can export to. So, because that'll be very important for them, for their economy to start growing, so they can export to the US. And then that's good for us, because if Europe pick up, a lot of our exports go to Europe. So we think that actually things are looking okay. China fine, Europe, it's going to take a long time for them to recover, and it'll be a very slow recovery, but at least they're not contracting anymore and they're not going down. The US growing nicely, emerging markets doing okay, and you almost have a synchronized global recovery, and that'll be excellent for Billiton. So that's why Billiton, very good, well-diversified company, great management, and that'll be it's our number one holding in all our portfolios.
I'm sorry to have asked two questions in one because I already went on to Aspen, and we'd be remiss if we didn't get your answer on Aspen. Then I promise you I'll stand down for the rest of the interview.
Aspen is another one of those companies that is probably fully priced, and that is the problem with a lot of the JSE stocks at the moment, but it's a fantastic company. We really like management, we like what they're doing, we like what they're doing in Brazil, in Africa, in Australia. So it's one of those shares that we won't try and sell it now because we think it's fully priced and buy it back 20% cheaper. We realize that it might move sideways and maybe tick down slightly over the next 6 months until it re-rates again. But that'll be one of our shares. It's been a core holding in our portfolios for many years, and it'll continue to be so.
Mike, the last time you came onto the show, you talked about the holding in Sasol as kind of like a guarantee or a insurance against the rand. That's proved particularly pressured now that the rand is hovering at about 10 to the dollar. Did you foresee that? Did you and the team at Ford foresee that the rand was going to blow that big, or was it more just a case of the fundamentals around the current account and the budget deficit led to potential vulnerability there? And then, of course, when the strikes came last year, that was the first step in the rand's demise over the last decade.
Look, we generally are rand bears, unfortunately. I think our targets for year end, when we did our macro numbers at the beginning of the year, was 10 to the dollar. So we have been feeling that the rand.
I remember hosting an investment conference, and Ford put on the table 10 to the dollar. It was actually as early as the beginning of last year, and the whole room was aghast that it was such a bearish view. But there you go. Kudos to your team. Yeah.
So, and we think if the wage negotiations don't go well now in the next couple of weeks, you could see it go to 11. On a short-term basis. So, but we think at this level now it should settle down between 10 and 10.50, and it actually should help manufacturing. It actually should help our balance of our current account deficit. So, this actually is quite healthy, I would think, for the country as a whole.
Mike, we can't see the whole portfolio, obviously, on the information that we're provided with. But with what's going on in the platinum sector, has the company taken the opportunity to buy some of the platinum shares at this point?
Not really yet, Warren. We still, obviously, it very much depends on Europe recovering. And as I said, it's going to be, we think it might start, but it's going to be a very slow recovery. So that's where a lot of our exports go. We're still very concerned about the mining industry in South Africa. And that's why we've had no gold shares. We've got a very small amount of platinum shares because we do think it's getting deeper and it's more difficult to mine in this country. But I think as soon as we start seeing signs that Europe is recovering, we'll increase our weighting in the platinum shares. But at this stage, it's still a very small weighting.
I said I'd stand down. I'm so bad. I'm quiet.
You sure, brother?
Yes, 100%. I'm holding myself down to the desk.
Okay. We've got, Mike, just to come back to it, it's obviously a balanced fund, and we're always fascinated to hear the opportunities that abound overseas. Obviously, we don't spend a lot of time talking with balanced fund managers about the fixed income component because everyone gives us the same answer, so we've kindly accepted that. So if you'd like to divert from that, please do. But I think we'd obviously be interested to see where opportunities have been found overseas in the equity markets. And just give us, before you do that, the summary of the split between your offshore and local allocation.
Okay. And then we can just briefly touch on fixed income because you could see what's happened to yields now over the last couple of days. So we're back to 820. So there will be a time when it is attractive again. We've stayed out of the bond market for quite a while. We've felt it's not an area to be in. But when you get around 9% yields, or, then that starts looking attractive again. And even with our property shares, which we prefer really to bonds, because you do get an increase in yield over time, again, starting to look attractive. Growth point down 5% today. The yields are starting to look reasonable. So that's something that we also would start looking at now at these kind of yields. Talking about offshore, for us, offshore is again looking for good quality shares. I think that's forward is how we do business. We try and buy good quality shares here and the same over there. So most of our top 10 holdings in the Ford International Trust are in companies that have been around for over 100 years, like the Johnson & Johnsons, the Nestle's, the Vodafones, the companies that have really been there, good dividend yield, because we feel we like equities as an asset class. We think it's by far the best asset class out there. But what protects us is if we buy in quality shares, that if there is another 2008, those type of shares will bounce back quite strongly.
Your allocation to JSE commodities, on the fact that you said you are commodity bulls, that underpins your decision to have BHP as your top equity exposure on the local front. We're talking here pure play into the ETFs, on the New Gold ETF, is that what you're looking at?
Yes, that's our only exposure to those ETFs. We've got about 3.5% in New Gold. But
do you see gold as a currency?
As a protection again.
As a protection again.
So that's just in case we do have this financial Armageddon. We'll just put, it's not a lot, but we'll have 3.5% there just in case. It's again trying to get that balance right. So, and I think that's how Ford manages money. We don't take those one love bets. We're not sure if this global synchronized recovery will take place, so we'll have bulletin, but then we'll also have non-commodity rand hedges in the portfolio to protect against the rand. We'll have retail stocks in there in case the rand strengthens. So always trying to balance the portfolio, that in any kind of scenario we can give our clients a good absolute return, and I think that's what we try and do.
Mike, just a question that a theme that we've kind of identified on the show. We've seen many big investment houses come onto the show, kind of missed the boat on listed property in South Africa in particular. I wanted to see if Ford was one of those, and what your sort of prospects or thinking was around the prospects for the sector, because it seemed to be called written off the last 3 years. No, this is the end of the property run, bond yields are coming down, we go through this story, and then every year we get like a 40% return from listed property. So what's Ford's view on that at the moment?
We've always liked property, but the yields became too expensive for us. When it came from a 9.5 yield down to 5.5, we just weren't interested. But we got it a bit wrong. We got bonds wrong as well. We were already out of bonds 3 years ago. We had 10% in our property unit trusts 3 years ago. We've sold that down over time down to 5%. So we have missed out on some of that run. But I think we might be justified over the next few months in that view, and hopefully then we can buy back our bonds and buy back our property trusts at yields that we feel are worth the risk.